Here's what's coming up on today's show.
So think about this. If you are going to inherit money from mom or dad or brother or sister or something like that, if you're a high wage earner right now, does it make sense to pull money out of those pre-tax accounts and then dump that in on top of your already high income and maybe push you into another tax bracket?
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
Let's talk about this great wealth transfer, guys. Trillions, I said trillions of dollars that are going to be passing from the baby boomers to their kids and grandkids is really on the docket for the next 20 years. Experts are saying somewhere between the neighborhood of 40 trillion and 100 trillion. That's some big money, y'all. What you guys think? Is this
it is big money.
Pretty
and we're
accurate?
not talking government $1 trillion.
No, this is personal wealth, right?
That's right, personal
Well,
wealth.
a lot of wealth is going to transfer. We saw this thing on YouTube. Is either a congressman or a senator, or a guy at the House or the Senate.
Somebody,
he was doing
right.
these boards and putting them up, and man, it was good, and I can't find it again.
Yeah, his
Was
name
that Rand Paul?
David something.
Oh,
no,
was it
it was
Rand? Okay.
David. He has white hair. You could tell he was very passionate about all of the debt that's been running through and Social Security, Medicare, and
And then the goofy
trust,
rules around it.
and the what's it called? Transportation fund is going to be like going broke over the next
as everything else is
10
too.
years.
Yeah.
Sorry to bring that in here, but one of the bullet points that I took out of that
Right.
was we have a whole bunch of 31-year-old people
Yeah.
in the United States of America. I didn't really pick up on that, and all of a sudden I started thinking, it's like, wow. You think about, we have a son by the name of Cameron, definitely in that age bracket.
Right.
And he's got a whole bunch of friends, and I'm like, man, that's a big demographic.
It is.
And then if you look at our demographic, the people that were born really, post 47, 50, something right in that range.
Well, I'm an Xer. I don't know about you, but I'm a Gen Xer.
Well, I don't know. I'm probably a boomer.
Yeah.
But, if you think about that group, say 60-ish,
Right.
we've probably got another good 20, 25 years in front of us. But, when we're done, there's a pile of money there.
Big
because,
pile.
a lot of it came from our parents. I was looking at Jennifer's father was a mailman and was in the Army. Craig's father was a mailman and was in the Army. That's a little weird, by the way.
Yeah.
But,
yeah.
they had pensions, big pensions, and so never really used the money they saved. They paid for college and some things like that, but really didn't need the income because they had the income, coming from pretty reliable sources. But now that we have our generation, which really didn't get the pensions as much, and the younger generation below us, what's a pension?
Right.
And so, you start looking at it and saying, okay, money from us transferring to them, how is that going to transfer?
And given the state of the economy and the government programs, and they're talking about Social Security going broke and Medicare going broke and transportation, fund going broke, it's even more critical now to really look at those generational transfers and how to maximize those dollars, right?
Because they got a target on them if you're not careful.
They do have a target. And so really the blessing is to try to bless the next generation. Yes, live on the money that you've earned and that you've acquired through your inheritance, but how do you then pass that to the next generation?
Yeah.
And so there's three things that we're going to be talking about. Primarily three things we're going to be talking about today on the show are those three things. One, understanding the rules on inherited IRAs.
That's a big one.
Understanding stepped-up basis. What the heck is that? And then basically communication. So let's dive in, Craig, and let's talk about understanding rules on inherited IRAs.
Well, let me lay it out for you.
Yeah.
So not so much between spouses, because that's a spousal transfer, but parents passed away, making it simple. And they still have money in IRAs. So you can either take a direct distribution and pay all the income taxes the day you get it. Well, not the day, but the year you get it. Or you can roll that over into an IRA that's in, still has mom or dad's name on it, but it's an inherited IRA. So you have yet to pay the taxes on that. So rules have been changing. The Secure Act changed some things, and you need to understand how you take that money. And then secondarily, you need to understand how it's going to distribute over the next 10 years.
Right. So Basically, when you're talking about the IRAs, you're talking about those pre-tax accounts. So as simple as SEP or an IRA. Before the Secure Act 2.0 came in, you heard the term of stretch IRA. So it didn't really matter whether you were a spouse inheriting it or a child inheriting these funds. You had been able to stretch that required minimum payment over your lifetime. So that's why it's called a stretch. Well, the Secure Act 2.0 kind of changed all that, too good of a good thing, right? So only spouses now are able to stretch that IRA over their lifetime and take those required minimum distributions. In general, we're going to talk a little bit about generalities. It's very specific now with the Secure Act 2.0. And in general, if you are a non-spouse, unless you meet certain criteria, then you have to take required minimum distributions and get the account paid out within 10 years. Again, generalities. So really, when you're looking at the calculation of an IRA, you want to, the government says that they've basically laid down rules that you've got to take a certain amount out at certain times. How is that calculated? It's dependent upon the originator's date of death, which rules are that you're subject to. It's also related to, did the originator have to take RMDs during their lifetime? Had they reached their RMD age? Then you need to look at who you are in this hierarchy. Are you a spouse or are you someone non a spouse? There are certain criteria that you qualify for a little bit more leniency on your RMDs if you're considered an eligible designated beneficiary. What the heck is that? So if you are either chronically ill or disabled non-spouse, if you're a non-spouse beneficiary, not more than 10 years. So let's say you inherit it from your brother, or your sister, probably within that 10-year time frame. Or if you're a minor child of the account owner, biological child or legally adopted, but only until you reach that age 21, you're not required to take those minimum distributions. Once that child reaches 21, then they do have to take those distributions and deplete the account within 10 years. So it really becomes complicated. We have a worksheet that if you have inherited a traditional or a pre-tax IRA, it'll tell you kind of how to take those RMDs. You've got to look at a single life table probably that the IRS puts together, and it'll tell you what that factor is. And basically, the calculation of a required minimum distribution. Why do you do all this? I mean, we're talking all these details. Let me take a step back. So the reason why you have to take a minimum is the government says, this account has never paid taxes, and we want our hand in it. So they're going to give you a calculation to say, you've got to take a certain amount out at a certain period so we can get some tax money off of you. Basically, that's what it is. Does that mean that's all the money you can get out of the account? No. You can always take more. It's called a required minimum distribution, not a required only distribution, right? So there are things you want to do, and how do you pass that money down? Do you go ahead and try to minimize the taxes now? Do you want to look at your tax implications? When you take this distribution from a pre-qualified account, it becomes taxable income to you. So what does that do to your tax line in any given year? So critical when you are looking at your retirement income to manage your tax line by like nobody's business, because that's really the only thing you can control, right, Craig? Right. You got your income and you got your taxes, and that's really all you can control. In any given year, the government's going to change it. They're already changing it in 2026 with the sunset of the Jobs Act. So you really need to plan on that. So that is one way to transfer wealth and stretch the tax liability.
So think about this. If you are going to inherit money from mom or dad or brother or sister or something like that, and you have a 10-year window, and let's just take the required minimum piece out for a minute. There's a window of time where you have to get this out. So if you're a high wage earner right now, does it make sense to pull money out of those pre-tax accounts and then dump that in on top of your already high income and maybe push you into another tax bracket? Or as you're looking out into your future, are you going to perhaps retire? Maybe you're going to back off, and your cash flow from work is lower, and you may be able to do some planning and manage your tax line a little better.
And Craig, we haven't even really talked about the Roth IRA and how that changed. Before, you could actually stretch that Roth IRA as well. Now that's gone away for non-spouses, and that they do have to start depleting that account within 10 years. So
it's tax-free, but you have to take it out.
Right. So there are ways to use the tax code the way it's written now under Secure Act 2.0 and understand the ramifications that it has on your income. The only way to do that really is to sit down with someone who knows the rules, can show you how to calculate these things and the impact it is on your particular income at any given year and what the tax implication is. The whole point is to keep more of what you've earned or what you've inherited. Our offer to you is if you give us a call, 336-448-1086, Craig or I will sit down with you to understand what you've inherited and how that works with the rest of your assets and your income to generate that retirement that you desire. Our number again is 336-448-1086.
All right, so we're talking about the Great Wealth Transfer, guys. Craig, hit me with the step up in basis. Take me country line stepping or something. I don't know. Do something here.
Hit me, baby. So what is a basis? You buy a house for $100,000. You live in it for 30 years, and then the property is worth $500,000 to make it simple.
Which kind of is now,
Your basis is $100,000 in my example. So if you sold it, you have a gain. You have $400,000 in my example of extra money that you made over what you paid. So your cost basis in my example would have been $100,000. So here's what you should do in most cases. A lot of people make some mistakes. At your passing, at death, the value of the property and other assets resets to the value at the date of death. If you think about that, that means that $500,000, if your heirs inherit it, is where they start for their taxes rather than your $100,000. So common mistakes: giving an asset like real estate or stock to somebody versus inheriting. Well,
we get this question all the time. The kids will say, should I put the house in my name now? Should mom gift the house to me now and I let her live there?
And the answer is you can, but from a tax perspective, it's a bad move because you will assume what mom paid because she's not passed away. Same things as if you give your Microsoft stock to your kids. You paid $100 for it and it split half a dozen times and now it's worth $1 gazillion. Here's the Microsoft stock. If they sell it with your cost basis, then what happens is they pay the tax. It's a capital gain, but they'll pay the tax on that capital gain. But if they inherit that stock from you, if they inherit that real estate from you, better. So that doesn't mean you should never gift. I'll give you some examples. Let's say you have a 21-year-old kid that has yet to earn any income, just got out of college. Maybe they're going to grad school. And you want to give them some money, and you can look at your checking account and go, I can give them this money that I've already paid taxes on, or maybe I give them that highly appreciated stock. And you go, well, why would you do that? Well, they're adults. You can give them the stock. And if they earn as a single person less than $47,025 off of the sale of that appreciated stock, there's no tax, a zero. So, okay. Did that work? Yeah, that would work, but you have to have some planning ahead of it. You need to be deliberate in how you approach it. Otherwise, you create tax. Or maybe you're in a high tax bracket. Maybe you're a high wage earner. You're in a 32 or 37 or something tax bracket. For you to sell something, take the proceeds and pay for college, as an example, might not work. But if you gave it to them, and they're the age of majority at least, you have a different tax impact. Okay, so you have to look at it and say, what's the best move? How do you do that? So who are your team players on that? A good, solid tax planning CPA, not just a preparer. I'm sorry, guys, that just do the preparation, but they don't usually look at that. Or a financial planner. I prefer somebody that's a CFP because we've kind of gone down this road before.
Right.
So that's the reason why. But going back to what I originally said, typically in a generic comment, it's a little better to inherit a highly appreciated asset. I know Jennifer and her mother got into it about 2 years ago. She wanted to sell the property up in Kentucky. I want to sell it. And she doesn't.
That's pretty much the way she sounds too.
A little bit worse than that, but and she's like, Mom, do you need the money? And the answer was no.
Right.
And then, okay, so if you sell it, you pay this
gosh awful,
terrible tax, or since you don't need it, why don't you just continue to own it? I mean, you're 93.
You can always sell it later.
And it's still sitting there, and it's better for her kids to inherit it if that's the end user anyway. So what I'm trying to say is look at it that way, because things like putting your children on the house deed negates your step up. It may be a mistake. If they own even part of it, the value that they own is not stepped up.
Right. Only your portion,
That's
if you
right.
still,
Right.
whoever the decedent is, their portion would get a step up. So you get a partial break in the taxes.
Well-
But the tax rate would be considered whether it's on whatever asset it is, that step up and that difference
Right.
between what your cost basis is and what the sales price is,
Right.
would be taxed. It's not taxed as ordinary income, but it is taxed as capital gains,
Well,
right?
that's what I
Because
was
it's
gonna ask,
long,
yeah.
and typically it's long term
Right.
because the asset has appreciated over a long term, and so it would be at 15 or 20% under current tax rates.
Well, probably 15. It's a big wide gap there on the 15.
Okay.
So let's do this. Let's just look a little deeper and say, okay, if you were looking on the other side of it and you inherited stuff, so mom and dad passed away, they had all of this stock over at Computer Share or something where they're doing dividend reinvestment.
Nightmare.
Yeah,
Just kidding.
if they sell it, every dividend has to be, if you're going to do it correctly, would have to have its own cost, and it's very difficult to do. But the day after they pass away and you inherit it, so much easier, because now you have a value of all the shares at that one point in time. We see it all the time. People will have accounts that came over from mom and dad, and I'm looking at it and it's like, when did they pass away? Oh, well, they 7 months ago or 6 months ago, and they'll be like 20% gains in this. I said, you need to go back and recalculate this. We'll do it for you. Reset the cost basis as of the day they passed away.
And you don't have to hold that asset 366 days for it to be a long-term cap gain to you. If it was long-term for the decedent, then that carries over to you as the inheritor of that asset. So you can basically sell it the day after it goes into your name. So you don't have to wait that period.
Let's finish this up. Let's talk a little bit about how you should be talking to each other, meaning you, the owner of the asset, and your heirs, because it's hard. Especially the generation before us, those people won't say anything.
No, they don't.
But at least the boomers seem a little more willing to talk to their children about, I have this stuff, and here's how it's going to convey to you. So having a conversation. So at Maestro, what we love to do is a family meeting. So we get everybody together. Usually nowadays, with everybody in different states, we have to do the Zoom thing, but you can do it. And we can discuss estate transference issues. You impressed with me?
I am.
I thought so.
You said it very
So you don't
succinctly.
have to tell your kids how much they're going to get, but having them understand the process. Here is how this is going to transfer to you. If you have a revocable trust and the asset is owned by the trust, it has a different transference than if you're going to say you just get it and the will take care of it. We'll have to run it through probate. It might take some time. Could there be some arguments? It's a little more efficient if you have the trust, but it's best to explain to your heirs and say, this is how it's going to work. If you're uncomfortable with that, you can use your estate planner, your attorney, bring your CFP or financial planner in on that meeting and say, here's what we'll do, and here's who you need to reach out to when this happens. So here's where the documents are. You have to have the original will. There's a lot of good things to do there, and if you can set that up right, much better.
And then the next generation understands the thought process of why you did certain things. And that way, inadvertently, they don't mess up the original plan and the purpose. As an example, let's say that you had set the assets to go into trust for them, and the trust was going to basically stay almost in perpetuity. Not really, but it can stay for the lifetime of that child, and the child can be the trustee of their own trust. Why would you do that? If the child doesn't understand the ramifications of why that's beneficial to them, they might say, I don't want to deal with this. I just want to pay all the assets out to me and just put it in my name. And you totally don't understand the whole purpose of why that was
which
done.
Which is typically asset protection. Lastly, before we get out of time, things you might not know. Right now, you have a big estate exemption. If you have an estate greater than, $13.6 million per person right now, there are no estate taxes due under that number, which covers a lot of people. So barring a change in tax laws, that threshold is only a temporary one, meaning that when Trump put the tax cuts and job acts into place in 2017, Congress would not make it obviously permanent. And so this large estate tax exemption is supposed to sunset at the end of 2025. So if you
Which it'll revert back to more like a $6 million plus a little bit of appreciation per person.
Who's talking here?
I'm sorry.
I'm sorry. So sending the estate and gift tax exclusion back to its pre-2017 level, which was $5 million, and we're assuming, based on what the estimates are, that the threshold will be around $6.8 million.
See, I said it in so much fewer words.
I agree. All of your assets are included in this calculation. So people we see have estates of $6 million. And so if all of a sudden the next dollar is going to be taxed at 40 or 45%, you need to pay attention to that. Are there things that you should do now in order to take advantage of the $13.6 million exemption, like gifting some things around and moving some money around? It might be a good time to visit your estate attorney and see if there's things that you can do now under the current tax laws. All I really wanted to get out there.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.